Automated market makers, AMMs, have emerged as a groundbreaking innovation in the DeFi landscape, revolutionizing how assets are traded and how liquidity is managed. Let's dive into how AMMs work, their core components, and the profound impact they have had on decentralized finance. Understanding automated market makers, AMMs. Unlike traditional exchanges that rely on order books and intermediaries, AMMs facilitate trades through algorithms and smart contracts, operating independently on decentralized platforms. Liquidity pools. At the heart of AMMs are liquidity pools, which allow users, referred to as liquidity providers, LPs, to deposit pairs of tokens into a smart contract. These pools enable decentralized trading by creating markets for specific token pairs, such as Ethereum, ETH, and USDC. Pricing mechanisms. The most common pricing formula used by AMMs, such as Uniswap, is the constant product formula, X times Y equals K. This formula ensures that the product of the quantities of two tokens in a pool remains constant. As one token is bought and its quantity decreases, the price of that token increases, and vice versa. Swapping and slippage. Trades on AMMs, known as swaps, are facilitated automatically based on the pool's token reserves. Larger trades relative to the pool's liquidity lead to slippage, where the price changes unfavorably for the trader due to the dynamic rebalancing of the pool. Fees and incentives. A small fee is charged on each trade, which is distributed to liquidity providers. These fees act as incentives to LPs, compensating for their potential exposure to impermanent loss, a temporary decrease in asset value caused by price fluctuations within the liquidity pool. Impact of AMMs on DeFi-enhanced liquidity. AMMs have drastically increased liquidity in decentralized finance by enabling continuous trading without the need for high liquidity requirements. Even smaller or newer tokens can benefit from liquid markets through decentralized exchanges. Lower barriers to entry. The removal of centralized order books has democratized participation in financial markets. Any user can become a liquidity provider or trade assets using an AMM without needing deep technical expertise or significant capital. Innovation and variety. The success of AMMs has spurred the development of numerous innovative platforms and protocols. New features such as yield farming, liquidity mining, and advanced pricing algorithms have accelerated the growth of the DeFi ecosystem and introduced more complex financial strategies. Challenges and risks. AMMs are not without risks. Impermanent loss can reduce the value of LPs' assets, especially in volatile markets. Additionally, smart contract vulnerabilities pose security risks, making it crucial for users to carefully assess platform security before participating. Case studies. Prominent AMM protocols. Uniswap. Launched in 2018, Uniswap is the pioneer of the AMM model. By using the constant product formula, Uniswap has facilitated decentralized trading and inspired a wave of similar projects. Uniswap's simple yet effective model has become a cornerstone of decentralized finance. SushiSwap. SushiSwap began as a fork of Uniswap but introduced its own innovations, such as governance tokens, Sushi, and additional rewards for liquidity providers. SushiSwap emphasizes community-driven governance and offers LPs a more active role in the platform's development. Balancer. Balancer takes a more flexible approach to AMMs by allowing liquidity pools to contain multiple tokens with customizable weightings. This innovation enables users to create and manage more sophisticated portfolios, providing additional liquidity options and improving capital efficiency. Yield farming and liquidity mining. Yield farming and liquidity mining are strategies that have become popular within the DeFi ecosystem, allowing users to maximize their returns by providing liquidity to platforms in exchange for rewards. Yield farming. Yield farming involves depositing assets into a DeFi protocol to earn rewards, often in the form of governance tokens. By staking liquidity in various pools, users can optimize their returns by leveraging multiple DeFi platforms and strategies. Liquidity mining. Liquidity mining incentivizes users to provide liquidity to a protocol in exchange for rewards. These rewards, typically distributed in the protocol's native tokens, create a symbiotic relationship between the platform and users, as increased liquidity improves trading conditions, while users benefit from the rewards they receive. Yield farming and liquidity mining are two pivotal strategies within decentralized finance, DeFi, offering users opportunities to earn rewards and enhance their returns on crypto assets. Let's explore how these concepts work, their differences, and the key risks involved. Yield farming. An overview. Yield farming, also known as liquidity farming, allows participants, known as yield farmers, to provide liquidity to DeFi protocols in exchange for rewards. How yield farming works. In yield farming, participants lock up their crypto assets in a smart contract. These assets are then used to facilitate lending or liquidity provision. In return, yield farmers receive rewards in the form of interest payments, governance tokens, or other incentives. Yield farming strategies often involve shifting assets between different DeFi platforms to maximize returns based on changing yield rates and incentives. Types of rewards. Interest payments. Similar to traditional savings accounts, yield farmers can earn interest based on supply and demand within liquidity pools or lending platforms. Governance tokens. DeFi protocols often reward liquidity providers with governance tokens, granting them voting rights and a say in the protocol's development. Fee sharing. Some platforms share transaction fees with liquidity providers, distributing rewards based on their contribution to the liquidity pool. Liquidity mining. A key component. Liquidity mining, closely related to yield farming, refers specifically to earning rewards by providing liquidity to decentralized exchanges, DEXs, or DeFi platforms. How liquidity mining works. Liquidity miners deposit their assets into pools on a DEX, receiving LP, liquidity provider tokens representing their share. These LP tokens can be staked or used to earn additional rewards, typically distributed in the form of the platform's native tokens. Strategies for liquidity mining. Staking LP tokens. Users can stake their LP tokens in dedicated contracts to earn extra rewards. Participating in reward programs. Some DeFi platforms offer bonus rewards and tiered incentives to attract liquidity providers. Optimizing yield. Liquidity miners often move assets between different pools to capitalize on the most favorable yields and incentives. Risks and considerations. Despite the potential for high returns, both yield farming and liquidity mining involve risks. Smart contract risk. Impermanent loss. Liquidity providers may experience impermanent loss, where the value of assets deposited in a pool changes relative to each other, resulting in a reduction in value when withdrawn. Protocol risk. Market risk. Decentralized oracles. Decentralized oracles are critical to DeFi protocols, providing the real-world data required for smart contracts to function effectively. Understanding decentralized oracles. Oracles act as intermediaries, fetching off-chain data and delivering it to blockchain networks. Decentralized oracles improve security by relying on a distributed network of data providers, mitigating risks associated with centralized oracles, such as data manipulation or single points of failure.